was regarding raising rates for inflation. See, segue.
All right.
Segue.
All right. So what's happening with rates?
Balloons. We deflated a balloon. Now we're gonna.
It stops being funny when you explain it.
Yeah, I know. So here's the federal chair. Before we get into this, let me just give you some background. So last week, the Fed met. They decided to raise interest rates 0.25% one more time. They might do it again. We'll see. But they were fairly optimistic because job growth was up quite a bit. I think the job growth was they had 511 new jobs, but the projection was 188,000. So that was a huge sign. Plus, inflation has gone down, and it's continuing to go down at a pretty good pace. All right. So this is called disinflation, right? It means we're not lowering the prices of things, but inflation, the rate of inflation is going down. So this is good when you have high inflation. What they panic about is things like deflation, where the rate goes negative, because if it starts going negative, then it really damages the market going forward and hiring. But anyway, all these things are really good signs. So things are going well. So Federal Chair Powell is going to explain kind of why they're continuing to raise rates even though things are looking good. And that's basically the question here.
And thanks as usual. So I just wanted to connect a couple dots here. The statement made a number of changes that seem to be saying things are getting better. You're saying inflation has eased. That's new. You've taken out references to the war in Ukraine as causing price increases. You've taken out references to the pandemic. You've eliminated all the reasons that you said prices were being driven higher. Yet that's not mapping to any change in how you describe policy. We still have ongoing increases to come. So I'm wondering, why is that the case? And does it have more to do with uncertainty around the outlook, or more to do with you not wanting to give a very overeager market a reason to get ahead of itself and overreact?
So I guess I would say it this way. We can now say, I think, for the first time, that the disinflationary process has started. We can see.
What was that?
I said I appreciated that question. Way to just cut straight to the point. Yeah, because sometimes you kind of wonder that, right? Are they just doing this to stave off some reactions,
Right. So what's the strategy here? Things are
right.
Things are looking good. There's really no reason for you to raise it. What's the thinking behind it? And we kind of talked a little bit about this last week with Davos, which was the thinking behind it was still is they want to quell the labor market some, because right now wages are growing because labor has more control and more leverage to ask for more money. Now that
God forbid the worker have any control over anything.
Right, but that raises inflation too. So that's what he's worried about it. So let's see what he says.
And we see it really in goods prices so far. Goods prices is a big sector. This is what we thought would happen since the very beginning, and now here it is actually happening. And for the reasons we thought, it's supply chains, it's shortages, and it's demand revolving back towards services. So this is a good thing. But that's around a quarter of the PCE price index, core PCE price index. So the second sector is housing services, and that's driven by very different things. And we, as I mentioned, with housing services, we expect, and other forecasters expect, that measured inflation will continue moving up for several months, but will then come down, assuming that new leases continue to be soft. And we do assume that. So we think that that's sort of in the pipeline. We actually see disinflation in the goods sector, and we see it in the pipeline for two sectors that amount to a little less than half. So this is good, and we note that when we say inflation is coming down, that this is good. We expect to see that disinflation process will be seen, we hope soon, in the core goods the core services ex housing sector that I talked about. We don't see it yet. It's 7 or 8 different kinds of services. Not all of them are the same, and we have a sense of what's going on in each of those different subsections. Probably the biggest part of it, probably 60% of that is research would show is sensitive to slack in the economy, and so the labor market will probably be important. Some of the other ones, the labor market's not going to be important. Many other factors will drive it. In any case, we don't see disinflation in that sector yet, and I think we need to see that. It's the majority of the core PCE index, which is the thing that we think is the best predictor of.
Okay, so just to simplify it, so the guy asked a great question, which is indicators are good, right? It looks like headwinds, looks like things are actually doing well, right? This idea that we were going to have a recession, doesn't seem to want to pan out because it didn't happen, not in any real sense. So he's saying, okay, well, yeah, you're right. Goods are good. The price of goods, we're seeing good disinflation, very successful, good stuff all around, right? Housing, we think, is going to start to see some disinflation in the cost of housing, which is also really good. What we're concerned about is services. We think services, the inflation rates are too high, right? What he's saying is wage growth is too high right now. So we want to keep this going until wage growth comes down to a more manageable level. Now, there are a couple arguments you can make. You can make the argument that, that would affect inflation and that could be negative to the economy, right? However, if that's the case, then why are goods and housing potentially going to come down if it's a negative to the economy? And why are we seeing the job growth numbers we're seeing? On the other side of that coin, the argument could be, well, you're just keeping it artificially high because there's interest in lowering the wage growth so that employers and businesses can have more control over the amount they pay employees. And that argument would be is if you're doing it that way, you can't say that. It's hard to say that, is Jerome Powell. But the argument for that would be is, well, we're doing that even though I know it's going to hurt the workers, but it's better for general business growth in the country overall. So I'm looking at a bigger economic picture. But at the same time, it's like, yeah, but you're kind of fucking over the workers to get that done. And then the third argument, the counter argument to that would be is you don't need to do that if things are going well, which is kind of related to the first argument, which is if things are going well, what's the problem with seeing moderate wage growth? Now, if it was excessive, if wage growth was like 20%, then yeah, I could see some really big shifts and damage to the economy, right? But if it's 6 or 7 or 8%, and it does that for another year or two, is that really a huge detriment? Especially since it's already been artificially low for decades. So that's just kind of what they're doing. I mean, there are lots of different arguments you can make on that. My argument would basically be is they probably could tamper down on interest rates. You'd see more growth in the stock market, which is going to help more people with their retirement, their savings, and you would support wage growth overall on the short term. Not necessarily the long term, but at least on the short term. But right now, you have a lot of labor where they're trying to unionize and things like that, I think it's probably in the best interest to let them do that, because the last time we did that, those were the biggest growth decades, in our country's history, is when people had unions and pensions and things like that. That would be
And what was the time frame in which you're talking about?
The 50s up till early, 1980. I mean, granted, it didn't translate to non-white people, but, or especially women too. But still, the people, white men had unions and things like that, and they could ask for better wages. That's the kind of eras we developed the 5-day work week, tamp down on child labor laws, things like that. But that comes with having organized labor, which I think has been kind of a scare if you're still thinking in sort of like trickle economics terms, right? Trickle down. And I don't know Powell's complete position, and I'm sure he's pressured to do certain things, but I don't know that it's devastating, but even raising interest rates, I don't think it's going to solve that problem for them, that it's going to necessarily taper down labor that much, especially after a pandemic, because you're talking about a pretty severe shortage in the labor market and a pretty severe cultural shock to the world not just our country. So I don't know where it's going to go, but I just wanted to kind of throw in that sort of argument on that.